Hi everybody, my name is Griffin Bridgers. It's my pleasure today to present single-member LLCs and Grantor Trusts and show you how they make an interesting combo. There are some pitfalls to note when you're combining these two types of entities, because even though their tax treatment is obvious when you look at each in isolation, it may not be so obvious after a transfer, for example, to a Grantor Trust. Before diving in, I want to remind you this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. So, when it comes to a limited liability company, it need only have one member. It can have multiple members, but you can have one member of a limited liability company. Contrast that with a partnership, which pretty much always requires two or more partners. Now, this creates a conundrum because, for income tax purposes only, an LLC is taxed as a partnership traditionally. But if it has only one member, it can't be taxed as a partnership because you have to have two or more members for a partnership technically. So what this means is that for tax purposes only, income tax specifically, a single member LLC will be treated by default as what's known as a disregarded entity. We'll see what that means below, but you also have the option with a single member LLC to make an election to have it taxed as an association, which is essentially taxed as a C corporation. And once you make that election, the single member LLC may also be eligible for an S corporation election. Now, this last series of elections isn't really the focus of today's conversation. We're going to focus more on this default rule and assume that a single member LLC is a disregarded entity. So what does this structure look like visually? Well, in this case, you have a single member of an LLC. They own 100% of the LLC interests, and the LLC owns assets. It might have a 100% interest in those. But what this means is that for income tax purposes only, since there's only one member of the LLC here holding 100% of the interests, the IRS disregards the existence of the LLC for income tax purposes only and treats the single member as if they are the tax owner of all of those assets. So what that means is that every single year, instead of having the LLC report an information or tax return, the income of the assets is directly reported on the single member's personal income tax return without the need for a K-1 or anything like that. But for state law purposes and all other purposes, the LLC would be treated and respected as the owner of its assets. So that's the disregarded entity treatment of a single member LLC in a nutshell. Next, we're going to look at grantor trusts, which I've talked about ad nauseum on prior presentations. But basically, if a grantor, i.e. the creator or funder of a trust, or a beneficiary, retains certain powers or rights with respect to a trust, whether it's revocable or irrevocable, it may be given a special income tax status known as grantor trust status, in which case, with respect to the grantor, there could be multiple grantors here, or with respect to the beneficiary or multiple beneficiaries, there could be a disregarding of that trust. So, like a single member LLC, a trust that is a wholly grantor trust is a disregarded entity for income tax purposes as well. So we have the same illustration here. Instead of an LLC in the mix, we have a grantor trust in the mix, where the grantor is treated as the income tax owner of the assets in the grantor trust itself. Keep in mind, as we're about to look at, those assets could include a 100% ownership interest in an LLC, which is going to create a little bit of a conundrum depending on who puts the LLC interest in. But for all other purposes, including gift and estate tax purposes, the trust would be treated as the owner of its assets, which is an important point for estate and gift and generation skipping transfer tax planning. But that's besides or outside of the scope of our discussion today, because I've talked about that a little bit before. But this seems to make sense, both the disregarded entity for both the LLC and the grantor trust. But what happens if you combine the two or integrate them? You may be able to stack both a Grantor Trust and an LLC, where the Grantor Trust becomes the 100% owner of the LLC, to create a consolidated tax ownership structure that is disregarded for income tax purposes as well, where you have two disregarded entities, the Grantor Trust and the single member LLC. But one must be careful to make sure that the entity is truly disregarded and that the trust is truly a Grantor Trust. And our focus and caution of the day will be really with respect to the single member LLC. I'm going to give you the stop sign caution here that you need to make sure the disregarded entity is truly disregarded both before and after the transfer to the Grantor Trust. If it's not a disregarded entity before, as we're going to find out, it may not be a disregarded entity after the transfer to the Grantor Trust, even though the Grantor Trust now owns 100%. So why does this matter? Well, let's assume husband and wife own 100% of the LLC interests, and they gift them to the Grantor Trust. Now, before the gift, we're going to expand on this a little bit more below. The LLC may actually be taxed as a partnership because husband and wife are two separate members. Their ownership isn't consolidated for income tax purposes. They're respected as two separate members, which means you have by default as a partnership. You probably cannot get disregarded entity status unless there are some special circumstances or elections in the structure of the LLC. So in this case, while there's now, after the contribution by husband and wife, a single member of the LLC being the Grantor Trust, the disregarded nature of the Grantor Trust means that nothing changed from an LLC ownership perspective. In other words, since you can look through the Grantor Trust, that means that husband and wife are both members of the LLC before and after the transfer to the Grantor Trust. So what does this look like? Well, here we have member 1 and member 2 who put in their 50% ownership interests into a Grantor Trust, which results in what you'd think of as a disregarded entity structure with respect to the LLC after the fact, because after all, the Grantor Trust now owns 100% of the LLC. But you have to look through the Grantor Trust, and you have to look at the relationship of member 1 and member 2 to the Grantor Trust. And if they put in 100% of their membership interests, well, after the Grantor Trust gets it, you're still going to look through the Grantor Trust and treat member 1 and member 2 as if they're still 50% members in the LLC. So the LLC cannot be a disregarded entity so long as the trust is a Grantor Trust. So this is something you need to be careful of, especially with spousal ownership, because in most cases, the tax code does not treat husband and wife as one partner of a partnership or as one member of an LLC, which makes sense, because for state law purposes, it's helpful to bifurcate ownership for creditor protection. There's a couple cases I note, the Albright case in Colorado and the Olmstead case in Florida. You may want to read up on those a little bit more. And you may have the opportunity for things like valuation discounts and other things if you have husband and wife or spouses as separate owners of an LLC. But there are only a couple real circumstances where state law can create one consolidated ownership unit among spouses so that you have a single member LLC. One would be where state law property rights treat the LLC interest itself as having one owner. Typically, you'd see this where you have community property. If the LLC interest is held in a community property state or was acquired in a community property state, or where it's titled as tenants by the entirety between spouses. In either case, you can treat the spouses as one member. Now, I want to note, subtle hint, you may be able to use a Tennessee trust to accomplish one or the other depending on the LLC situs. There's more to come on that. I'm not going to expand on that point today. But there's another out you may have in Code Section 761F, which recognizes a qualified joint venture that may be disregarded if there's two owners who are both spouses who have a combined 100% ownership in the joint venture. And here's the catch. where both materially participate in the venture. So if you can't have community property or tenancy by the entirety, you have to meet this qualified joint venture and material participation standard, which may be difficult with an investment partnership that's not carrying on an active business, or with an actual business partnership or LLC where only one spouse is really participating in the day-to-day operations. So because of that, this may be a more difficult hurdle than it looks like at first glance. So what are our key lessons here? Well, when you have multiple members who sell or gift a combined aggregate 100% of their LLC interest to a grantor trust, the LLC may not be disregarded after that contribution or sale, even though there's now just one owner of the LLC, being the Grantor Trust. You need to be aware how this affects not just the filing status of the LLC for income tax purposes, but also the qualification for other, tax benefits. Things like if the LLC is doing a 1031 exchange, well, this might be a red flag that keeps it from qualifying, even though it looks like on its face the Grantor Trust has a 100% membership interest in the LLC, because the LLC is not disregarded and as a partnership may be ineligible for a 1031 without a drop down to the sole member. And it may be a good idea here, especially with spouses, to consider maybe consolidating ownership of the LLC to one spouse before the transfer to the Grantor Trust if you want the LLC to be a disregarded entity after the contribution. But there are some pitfalls here to note. One, doing this is going to create a technical termination of the LLC for income tax purposes. So you're going to have to file tax returns as if the deemed partnership is winding up its affairs and becoming an asset, really, of the single member spouse now. And two, it's important to note that you have to be compliant with the procedures both internally for the LLC and tax reporting to make sure you set this up correctly to really track that there was a transfer to a spouse and then a gift by that one spouse to the Grantor Trust. Because if you disregard any of the correct procedures from a tax and LLC reporting standpoint, the IRS may disregard the spousal transfer for gift tax purposes. I cite the recent case of Small Dino, which you should dig into a little bit more. Especially if there's no gift splitting election, this could be the outcome. It may not be a good outcome. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com with the caveat that I cannot give tax or legal advice in response to your questions. But I thank you again for listening to this presentation. Be cautious when you're dealing with disregarded entities stacked between a Grantor Trust and an LLC. And I look forward to seeing you in my future content. Thanks again.